Disclaimer: this is not financial advice. Always do your own due diligence before putting your money to work. With that out of the way, let's have some fun and enjoy the episode. What's good, y'all? Welcome back to another episode of the Rich Out Games podcast. It's your boy CB checking in with you guys for episode 23. Happy Money Mondays. I hope you all had a happy weekend, enjoyable weekend, very laid back, relaxed weekend, man. With that being said, let's get right to it. Before we get started, man, I just want to let y'all know this one thing. When God is with you on your journey, it's hard for you to face defeat. Now, understand when I say face defeat, I'm not saying when you take losses and when you get set back or some certain things like that. Because on your journey with God, that will be the case. That will be things that happen that overall set you back and derail you from hitting the goal that you might have had intended for yourself or wanted to achieve in a certain period of time. On your journey with God, that those things might happen, but He won't allow you to face an upset that is detrimental to your ability to pursue the things that He has in sight for you to pursue. So on your journey, just keep that in mind, that no matter what you're facing and going through right now, God is still there with you, and He's not going to let you fail on your own in a way that you cannot come back from. Anything you're facing right now that you feel like is overbearing and it's a lot of pressure and it's a lot of uncertainty, just know that there is a greater side to this on the other side of the outcome. You just have to keep pushing through, keep guiding your life, keep faith in the things that you're pursuing and doing, that the outcomes that you are seeking will be on the other side. If you wanted to stay broke for the rest of your life, what would you do? And I'm being so serious when I ask this question, because a lot of times, most people aren't stuck by accident. They are not stuck by accident. They're not experiencing the lifestyle that they're experiencing by default. It wasn't a lifestyle that they were accustomed to. It probably was a lifestyle that they created over time. And so today I want to talk about 4 different ways most people stay stuck in life financially. Starting with number 1, most people trade their time for money. Now, don't get me wrong when I say this. I'm not saying that working a job is a bad thing. It's the mindset behind you working the job. Your intentions behind working the job is not to work so you can make money to now invest. Your job and your intentions behind working the job is to make money so you can survive. You're thinking in a survivability mindset rather than a thriving, abundant, investing, entrepreneurial mindset. And that's what's keeping you stuck. Your mindset and your perspective on trading your time for money. So every time you show up, you getting paid $20 an hour rather than not showing up at all and making $20 an hour. That simple shift in mindset is what changes you from being stuck to you now living an abundant lifestyle, because that same $20 an hour that you're making can change and increase based upon what you're doing to make the $20 an hour. Meaning investing, what you're investing the money into to generate that kind of return. So now it can not only make you $20, it can make you another $20 on top of the $20. So now it's making you $40. And then that 40 can now make you another $40 within the same hour. So now you're making $80 an hour. Your ability to produce a return for the money you invest is limitless. There's no limit to the amount of return on your investment. It's all simply due to your strategies and your approach and what you're doing to make the money. But most people don't get to that point. Most people get stuck on working to survive. So changing that one thing in your mindset when you're showing up to work and trading your time for money will help you get further along in life to not be stuck. The second thing most people do in order to stay stuck is they avoid taking risk. Now, you might think that that is actually a positive thing for you in life, but in reality, that's actually causing more negativity to your life than you think. If you choose to avoid taking financial risk in your life, it's causing more negativity because no matter what, the cost of living is going to go up regardless. Why is that? Simply put, it's due to inflation. The cost of living rises year after year. So if you're choosing to not take risk and you're choosing to stay comfortable and make the same amount of money each and every year, the cost of living is going to increase while your payment is staying the same. The amount of money you're making is staying the same. So now what you're seeing happen is more strain being added to your life because you're making the same amount of money in an environment that costs more. I hope that stuck to somebody. I hope you guys are hearing what I'm saying. You not taking the risk is costing you more because the cost of living is going to go up regardless. So you accumulating more expenses in the cost of paying rent, cost of buying groceries, cost of going out, cost of all these different things are continuing to go up and up and up and up every single year. Yet you're making the same amount of money because you're choosing to stay comfortable. It's costing you way more than not taking the risk. So instead of not taking the risk, just take the risk. Set aside 100, set aside 200 a month, however much you're able to set aside and invest that money to possibly generate a better return on that money rather than just letting that money burn and go to fixed and required expenses, because those expenses are going to be there regardless whether you like it or not. But I'd rather you take the possible risk of making a good return than taking the guaranteed expense of paying that bill that you have to pay each and every month. The third thing that most people do to stay stuck is they spend everything they make. Now, if you're spending everything you make on something like an investment, that's a different story because now you're trying to invest, put your money in a place to make a better return for you without having to do anything. I commend you and I clap your hands to those of you that are doing just that. But those of you who are going out buying food, buying tickets to concerts, tickets to flights, tickets to movies, going out, hotels, clubbing, all these different activities, you're making all the wrong decisions with your money right now because this is the cheapest amount of money. This is the cheapest cost it'll cost for you to make the investment. As you get older, it'll cost you more and more to make the investment because as you get older in age, the cost of the opportunity increases because now you have more responsibilities and you have more accustomed expenses added to your balance sheet rather than when you're young, at your youngest point, coming out of high school or coming out of college, and you only have a car note or a car insurance or a phone bill. The cost of investing requires more of you because now you have to make more money to just make that base payment and then invest rather than just make the investment and then add on the expenses later. So you're doing everything backwards by consuming more consumption and not investing into production. Because over time, if you just consume everything all the time, guess what happens? Now you've consumed more than you can intake, because as I mentioned in the last point, inflation happens. So not only are you consuming, but now the cost of consuming increases. So with the cost of consuming increases, you run out of the amount of money you have to consume. So now what do you have to do? Go get a loan, go get a credit card, go get borrowed money and go in debt. Now you're in the negatives. Now you're consuming on money that you don't even have. So now you're really putting yourself behind because you're consuming from things that you don't have any assumption to consume. You have no money to consume these things because the cost of living has increased. So all these things combined start to compound and grow and make things a lot worse and turn into a snowball effect that impacts you way more than people think. So change this by not consuming everything you make into consumption and putting some of that money into production and something that is going to produce a return on the money you put into it. The fourth thing that people do to stay stuck is that they follow the noise, they follow the crowd, and they stick to the hype. They're always chasing the hype. They're always chasing the next big thing, the thing that everybody's talking about. And that's the worst time to get in. Whenever grandma, grandpa, uncle, auntie, cousins, and everybody's talking about the thing that had a big return or a big run up or something extraordinary happen, that is the worst time for you to decide to get in, because you're at the tail end of it. Because guess what? The people that got in when nobody was talking about it are going to start selling that thing that everybody's talking about. And so now you're getting at the peak of performance while everybody's coming in that was already positioned are starting to sell. And so now you're the liquidation. You're the people who's getting their accounts called on margin and the valuations going down of the account that you just put in because you wanted to follow the hype. You wanted to be a part of the emotional roller coaster that happens when people FOMO, have fear of missing out. And that doesn't just apply to investing. That applies to concerts, going to outing events. Anytime you buy into something, when everybody's talking about it, you best believe that the prices are going to be at the highest premium price possible compared to when nobody was talking about it and the prices were at a very fair, probably reasonable, even lower than average cost price. Stop following the hype. Stop following the trend. Stop being a part of the FOMO train and align yourself. Get in tune with your frequency and your clarity on your approach of what it is you want to do. Do your research. Be patient. Stay disciplined. Follow the data. Take actions on the things that you studied, and even when nobody else is talking about it, that's the perfect time to take advantage of the opportunity. So in conclusion, the systems around you are not the thing that's the problem. The systems around you are not what's broken. It's your system that's broken. It's your approach that's broken. It's your mentality. It's your mindset about the thing that's broken. So change your system, and then all the other systems hopefully will start to come online and work for you. If you guys want more tips and tricks about day trading and investing, make sure to click the link in the bio, www.continuebelief.com. I share a lot of free resources and tools, tips and tricks about how to day trade, how to get started investing, and so much more. So make sure you guys check out the link in the bio. Thank you guys so much. Make sure to leave a like and follow. And yeah, see you guys later. Investment tip of the week. On your investment journey, it's important that you know to take your time. It's not a race, and it's not something that is a get rich quick, race you to the top kind of approach. It's a take your time, be patient, wait for the right opportunity, and wait approach. Hurry up and wait. Okay, so cool. There's a pullback that just happened not too long ago in the market, and a lot of people didn't take the opportunity. And that was probably the best time to take that opportunity, seeing that we've had the reversal that we've had in the last 2 weeks. Little moments like that are the moments that you wait for in the market to capitalize and make your greatest return on investments. But a lot of people overlook those because they're caught up in the emotional roller coaster of everyday price action, looking at the ups and downs and the little movements that we're seeing each and every day to make decisions quickly. In other words, scalping. Now, for my day traders, that's not a new term, so you're used to that approach. But for my long-term people, or people that's trying to be swing traders or long-term investors, that's not your lane. That's not your approach that you have in the market. Your approach is to wait. Your approach is to be patient and wait for opportunity. Your approach is to take your time. So taking your time is waiting it out. Taking your time is doing the research, the deep research. Taking your time is understanding the companies that you're buying and not just making impulsive decisions. Taking your time is being disciplined. Taking your time is all these things combined, and when utilized properly, it'll help protect you from taking the losses that could damage your account, protect you from making impulsive decisions and making decisions that you didn't really want to make. It can protect you from making improper and low quality decisions compared to high quality decisions. And sometimes you might overthink things, and of course that happens. That's just a part of the game. But nonetheless, it will still, all in all, give you a better return on your investment just by simply taking your time. So taking your time is this investment tip of the week. It's important and it's imperative that no matter what you do in this market, especially because it's such a volatile session and season that we're seeing right now, with all the crazy news and all the different things and headlines coming out, it's important and imperative that no matter what you do, take your time. Don't deviate from your plan, your strategy, your approach, the things that you already are accustomed to doing. Don't deviate from those things because they still work. It just takes a little bit longer for them to work out. So just keep that in mind in this current market we're seeing. And that's your investment tip of the week. Can SPY, the S&P 500, reclaim 6,900 or 690? So given the prior week that we just had in the market, for those of you that don't know, Trump announced that the US and Iran came to a 2-week ceasefire. And in results of that news, that drove the market to have a strong rally and gap up. And since then, we've been sitting somewhere around 680. So do I think that the market can reclaim 690? I definitely think that it's possible, given the strong response to what was said. My concern is whether or not we are actually out of the woods of Iran and US being at war and the Strait of Hormuz being open or closed. If that's the case, then I think that it will trigger more buying pressure and more buyers to come into the market now that the fear of the war has come to an end, if it's actually ended. Basically is what I'm saying. If the wars actually came to an end, then yes, I think that the market can reclaim 690. There are still other things that are concerning to me in the economy, and one of the things that concerns me the most is the transfer of Chairman Jerome Powell and the new Fed chair coming into this economy. I don't know if we fully grasped or accepted that as of yet, since it hasn't happened. I think that will be something further down the road that will play a part in the market and its market flow. But right now, I think that the main focus that has been on everybody's agenda has been the Iranian war. So with the Iranian war coming to an end, if we're able to stay at an end and at a ceasefire and the war is over, then I think that the market can rally and reclaim 690. And I think that if we're pushing into late April, early May, mid-May, we can possibly even see closer to 700 and possibly even breaking 700. That's just my opinion. If the war is over, then I think these things are possible. If the war is not over, then this is just simply a dead cat bounce and a rally that will see a reversal sooner than later. Because if it's not over and it's just like a ceasefire and then we're going back at it, then we can see a very sharp reversal. And from that sharp reversal, we can possibly see even lower. But I like to be optimistic and not pessimistic about this, given that it's a war and, a lot of negative things happen in war, like deaths and things of that nature. So I hope that we're at a ceasefire that's coming to a close and conclusion for the war. But like I said, if not, and if things don't stick, then we can see a negative response in the market. With that, also playing a big factor in oil and the value of oil, can oil see lower? I think that oil will see lower eventually. It's just going to come down to, once again, whether or not we're actually at a conclusion of this war and if the war is actually over. So right now, I believe the oil prices are somewhere around $100. We had seen as high as 116 in March, and now that we're at ceasefire, I believe we're sitting somewhere around $100. So I definitely think the oil can see a dramatic drawdown price and pullback if we're able to conclude this war. There are still a lot of things on the back end that will play a big factor later on down the road that will impact the market once again. But as of right now, just on the immediate response of things, I think that the market will see a pullback for oil in particular in the coming 2 to 3 months, if not 6. So for me, at least 3 to 6 months is when I see, oil seeing a dramatic pullback, similar to like how the precious metals, early January and February, we saw the gold and the silvers and even the coppers push up to dramatic prices. Specifically, silver pushed up to very dramatic prices, but even in that month of March, we saw a very dramatic and very aggressive sell-off come into the market after the rally that we had in February and January. So I think a similar case is similar to oil and its pullback. It will see somewhat of an aggressive pullback as well after we come to a conclusion of the war, but we might see a spike back up in oil later in the year because one thing that the US did and that other countries did as well was use their reserves. And so using the reserves, that triggered another problem within itself, because those reserves were only meant to be used for times of uncertainty and slowdown around oil. And so within that, we have to refill our reserves, our countries and other countries as well. And then the infrastructure of oil production in Iran also plays a factor as well, because now within lowering the oil reserves, we now need more oil. So the demand for oil is still going to be there and a little bit higher. And then the production of oil, factories are needing to be repaired, is also going to play a factor into it as well. So that's what I mean by other things on the back end having an important factor and impact on the market later. Right now, I think the initial response will be us seeing initial drawdown come down and then a spike up later on in the year for oil. So that's just my personal prediction around the oil fiasco. But comment below your thoughts and let me know what you guys think about oil's positioning, oil's value, whether or not oil will see pullback or it will continue to rally. Now, granted, if the war does not come to an end and the demand for oil is still at a high, then we will see a very aggressive rally. God forbid that, because if oil continues to go up, things can get a lot worse. We're already seeing certain gas prices be at certain prices, but oil just doesn't impact gas. It also impacts food. It also impacts clothing. It also impacts pretty much our everyday lives and consumption around products. And so these are things to be mindful of and keep in mind as things progress or digress with the war. So I would definitely say keep an eye on it and just, make sure to watch the situation, monitor the situation, be mindful of what's going on, and try to put money up to reserve and just stack. Like, if you have the opportunity to not spend your money, then don't spend it. If you don't need to go out and have a reason to actually spend it, then don't spend your money. It's just that kind of economy. You want to be very reserved with your capital and, put your money to the side and let it stack. And then also, of course, investing, it will be the best choice, because no matter what economy we live in, investing will always be the solution, especially if you're getting a better return on your money compared to spending it on consumption. So that's just my opinion. With that being said, before we conclude the video, I want to just give thanks to God for blessing me with the ability to be patient, the ability to have stillness and be calm and collected in my approach of life. And throughout the whole journey, as I mentioned before, no matter what you go through, God will not let you face defeat if you have God with you by your side. And I can truly say that no matter what I've faced, no matter what setbacks I've faced or had thrown my way, I've always overcame them and been able to turn things around for me tenfold and just really see better outcomes on the flip side of the negativity and the negative things that happen in my life. So yeah, I want to give thanks to God for always being there for me, for always blessing me with the ability to make these videos, teach other people about investing and helping other people learn about the economy and the things that's going on in the economy and how to better position themselves mentally from a mindset perspective, physically from an actional perspective, and just so many blessings that I get from making these videos. It really brings me joy to make these videos, and I will continue to make these videos and create these podcast episodes so that you guys can get some form of value from it. But with that being said, you guys, this is episode 23 of the Rich Off Gains podcast. It's your boy CB checking in with y'all once again. I appreciate you, each and every one of y'all, for tapping in. If you guys are new, make sure to show up and show some love in some form or fashion, however you can. I appreciate it. Turn on the notification bell wherever you're watching this, whenever you're watching this. I will see you guys next Monday, same time, same place. Stay safe.